What is going on, guys? Nick here, back with another video. A lot of people have asked me since my first fundamental stock analysis video, how do we actually do deep research into a company? How do we read the financial statements? How do we read the 10K? And now this is a lot all at once, but I'm going to walk you through how I research companies so that you can do this on your own. So let's get started. Okay, so usually the first thing that I'm going to do is pull up the revenue and net income for the past 10 years. So if you go over to Morningstar and you search, you can hit the key ratios and then the full key ratios data. And right here you have a good table that shows you the revenue versus the net income. It's very easy to pull this up and see all the 10 years without having to go through all the financial statements to compile these together. So what I really try to focus on in this table is the revenue and net income. In general, I want to see revenue growing because it means that the entire business is growing. Usually. See my McDonald's video for an example of when this wasn't the case. Then I want to take a look at net income because I want to see a profitable business. It's most ideal, but there are certainly going to be situations like startups and businesses going through recovery that you're not necessarily going to see the profitability. If you take a look at my Uber and Airbnb video, you can see some examples of times when it wasn't a big deal that the company wasn't profitable yet. Ideally, I would like big profit margins of 10 to 15%, but this isn't a deal breaker. Some industries will always have lower profit margins, and that's okay too. The better the profit margins, the better the strength of the businesses. If you want to see great profit margins, take a look at Google. So at this point, I'll usually scroll down and I want to hit the growth tab right here. Morningstar gives you a really good chart that breaks things down in year-over-year growth, 3-year average, 5-year average, 10-year average for revenue, operating income, net income, and earnings per share. So really quickly, without doing any math, you can figure out roughly how much the company's growing. So now the next thing to do is to pull up the 10K. And you can just Google Amazon 10K and it comes up right here. And we'll use the PDF. So here's Amazon's most recent 10K. The reason I know this is because we can see right here it says for the fiscal year ending December 31st of 2019. Very important to make sure that you're reading the right one because there have been plenty of times that I've started to go through this and I realized I was looking at 2018 or 2017 or whatever. So if you scroll on down, the next thing that you're going to see is the table of contents. It's pretty self-explanatory, but there are a few things that you should really pay attention to. Depending on what you already know about the business, you probably want to start by just reading item 1, business. Usually these are mission statements that aren't always that specific, but you can start to get a sense of what the business is already about if they don't fully lay out what the company does. Okay, so if we scroll past the business section, the next important section is the risk factors. Now there's a lot of fluff in these and I generally don't spend much time on them. Usually important things are towards the top and the best way is to really just read the bold font, and if you need further clarification, just read the bottom text. Don't get too caught up in these unless you think that there's something really serious disclosed. Okay, so the next portion that I think that you should really pay attention to is the selected consolidated financial data. This segment breaks down all their finances into different segments and shows you some really good overviews of the current performance. It really depends on the specific business for how these are written, so I think it's a really good idea to scroll through all of these first to get an idea of how they break themselves down before you get too deep into any single chart. I spend the most time looking at the 10K in this segment. So if we look at Amazon's, for example, we can see that the first segment is some very basic reporting. It's net sales, operating income, net cash from operations, and some basic balance sheet metrics. It looks like the next chart is a basic cash flow statement. You can see they took in $38 billion in cash from operations, they invested $24 billion in cash, and then they paid off $10 billion in their financing activities. The third chart is their net sales by operations. When I break down different segments of businesses, this is where I get the info from. When you hear sales, make sure you think of revenue because that's basically what it is. I think it's very important to pay attention to the different segments of the businesses because a lot of times when I talk to people about companies, I hear things like, oh yeah, but this portion of their business is a real game changer. And then when I go and look at the segment, it only actually accounts for 5% of the revenue and none of their profits. And that doesn't mean that the segment can't take off though, but it's important to have a realistic sense of where things currently are. If you check out my Square video, when I looked at the Bitcoin segment, that's a perfect example of what I'm talking about. So if we scroll down a little farther, we can see their operating profit from each segment. We can see the North America and AWS segments generated a profit, but international was actually a loss for Amazon. So if we keep going on down, we can see their operational expenses are next. This is a great way to find out what they're actually spending their money on. If we scroll back up, we can see they took in $280 billion in net sales for 2019. Going back down to their operational expenses, we can see $165 billion went into the cost of sales, which is the direct cost to provide the goods or services. Usually you can find the exact definition below or somewhere else in the 10K. Amazon considers their cost of sales primarily consisting of the purchase price of the consumer products, inbound and outbound shipping costs, including costs related to sortation and delivery centers, and where they are the transportation service provider, and digital media content costs, where we record revenue gross, including video and music. The next segment was the fulfillment cost, and so this doesn't get too boring, I'll just summarize that these are the costs from staffing fulfillment centers, stores, customer service, and payment processing. We can see that the rest is technology and content, marketing, and general and administrative. We see below this is a cash flow statement. Now, if you followed my videos for a while, you'll notice that I usually don't talk much about the cash flow statements. I think that is a good thing to look at as a health measure, but I find that PE drives the stock valuations much more than the price to free cash flow. Some people will use price to free cash flow as their main metric, and I don't think that they're wrong to do so, but this channel is about making things a little simpler to understand, and sometimes adding a deep look into the cash flow statement makes these videos drag on a little too long. So the selected financial data segment tends to be a lot to take in. I would recommend always asking 2 questions when you first get here. The first is, how well is the different segments of their business performing, and where are their expenses going? Now, the last segment that I think is pretty important to pay attention to is the consolidated financial statements. These are the full cash flow statements, the income statement, and balance sheets. In my last video about fundamental analysis, I showed how to get a lot of this information off of Yahoo Finance. So this is pretty much as close to the information that you'll see on Yahoo Finance as it gets. So let's walk through the basics of how to read these. But before I do that, if you could take just 1 second to scroll down and hit the like button, I would really appreciate it. It really helps out the videos, it really helps out the channel, so that I can keep making videos for you guys. So the first statement that Amazon lists is their cash flow statement. There's basically 3 major things that you really want to pay attention to when you're reading a cash flow statement. Cash from operating activities, cash from investing activities, and cash from financing activities. Ideally, you're looking for a positive number for cash from operating activities and negative cash from investing and financing activities. Cash from operations is pretty self-explanatory. It's just cash their business earned. Cash from investing activities is cash that they've invested. You want to see a negative number because this means that they're investing their cash in things like new equipment and new buildings. Cash from financing activities are things like dividends, stock buybacks, and debt payments. If this number is negative, that means that they're paying off debts, and if it's positive, that usually means that they're taking on debt. The next statement in this is their statement from operations. This is basically the income statement. Usually, I like to think of these statements in 3 segments: revenues, operating expenses, and net income. Amazon lists their revenue as product and service sales, with the total net sales below. Then, they have all of their operating expenses, including the cost of sales. This brings you to the operating income. Then you have interest, taxes, and other income. This is basically interest on their debts, interest that they've received from investments, miscellaneous income, and taxes. The last statement is the balance sheet. I look at this in 2 segments, the assets and the liabilities. Assets are things that are valuable. Liabilities are things that they owe. If you subtract liabilities from assets, this gives you the equity. I like to pay attention to how much long and short-term debt a company has in comparison to their equity. This means that a company can borrow money if it needs it. When debt starts to get higher, they're less likely to be able to raise debt because lenders see the business as riskier. Usually, well-managed companies have a low debt-to-equity ratio. I think it's also important to notice the current assets to current liabilities. It's generally a good thing to see current assets as larger than current liabilities. You won't see this all the time, but if things get very lopsided towards current liabilities, there's probably some reason to be concerned about the short-term outlook of the stock. Current assets are usually assets that are either cash or something that can be turned into cash very quickly. Current liabilities are things like debt that they'll owe soon or payments that they'll owe within the next year. So the one last thing that I would also recommend taking a look at is the most recent 10Q. A 10Q is basically the quarterly earnings release. Usually these are a lot shorter and they just have a few financial statements, and they'll also summarize some of the things that have happened to them over the quarter or over the year so far. Okay, so now that you've gone through the 10K and the 10Q, do you know everything about the company? No way. What you need to do is start reading reporting on your own about the business. While these 10Ks are put together for transparency, remember they're also written by the company and not a neutral party. It's important to gain more insight into other perspectives around the business and how they currently fit into the overall market. 10Ks are a great starting point, and if you're reading them, you're probably 90% ahead of all the other investors out there. Now, I recommend using 2 websites, Yahoo Finance and reading through some of the news, and then also going on to Seeking Alpha. Seeking Alpha is a little more in-depth and better written than a lot of the stories on Yahoo Finance. Sometimes it can be pretty opinionated, so you can't take all of the articles too seriously. When the comments don't turn into political internet comment fights, they can actually have some pretty good counterpoints to the articles. It's always important to think for yourself and use common sense. Be skeptical and defensive, and don't make investments out of the fear of missing out. Okay, so that's the video. I hope this helps you learn to read through the 10Ks and the financial statements. They really don't have to be as difficult and confusing as people make them out to be. The more these financial statements you read, the better you'll understand what normal looks like. You can definitely learn a lot about the business from just reading them alone, so if you've been skipping out, make sure you take a look. And as always, thanks for watching.